Hi, everyone.
Hi. Hi,
Sorry.
Aditi.
Hi.
Hi, good morning, ma'am. I have
Hi.
the co-host, so I think now you can start.
Great.
Okay,
And
perfect.
can
We
you,
can
I'm
see
gonna
you.
just get a better video. And can we also get, can I get sharing rights so I can share my presentation?
Yeah, you've been made the co-host. You can, I think, do
You
everything
should,
that a host
I
can.
think you should be having the share screen button at the bottom or
No,
on the tool.
I don't. Oh, yeah, I do. Now I do. Yes. It's
Yeah,
just,
perfect.
so I had it open. Sorry. Okay. Is this okay?
Yes, go for it.
Okay. Okay. And what I'm going to do is I'm going to, not use all the slides. I'm going to go through, like I'm going to whiz through some. That's fine, right?
Yes.
Yes, absolutely. Absolutely. It's entirely, your discretion. I think the most interesting part is going to be the Q&A when the
Okay.
students quiz you on a bunch of stuff. So
Done.
we're going to encourage them to ask you questions, and so should you. That the more
Done.
interactive it is, the more interesting it will be. So just in terms of introductions, I wanted to introduce you to our head of academic content, Amlesh.
Hi.
Hi.
Hi. He is, really the driving force behind the academy. He takes care of all our academic issues, and really sort of engaging with the students in all aspects. And also, you see Aditya. Hi, Aditya. Aditya has recently joined us as head of faculty acquisition and corporate affairs.
Hello, Aditya.
Hi, ma'am.
And we have a bunch of others. We have 40 people online already.
Okay, great.
So
Are we waiting for the 100 or waiting for like 50, 60?
let's wait for a couple of minutes before we kick it off.
Great. And these are all students, right? Who haven't graduated.
All walks of life, really. They are mostly, undergrad and a lot of students who are, doing a one-year program, both data science and economics.
And women. Okay.
Yeah, large number of women as well.
Oh, so it's a mix, or is it just?
It's a mix. It's a mix.
I was told it was just women.
No, there's both, but don't worry. I'm sure they have.
My presentation is very geared for that, but I will mix it up.
Right.
But some of us may not be women, but I think most of us are feminists, so it's fine.
And the presentation is very basic for that reason, so
it's fine.
The first part is very geared to women, but I'm sorry, Tushar. I think there was some kind of misunderstanding, and I should have talked to you more. I thought that the audience was going to be women, which is why I've put the Winvestor. But anyway, I will also try to make it about men.
Yeah, I think men also need to be sensitized to this.
Yeah,
so.
yeah. Yeah. So then I won't start here. Let me start here because I shouldn't.
Yeah. So should we give it another minute, or Aditya, is there any people on who are still waiting to join?
I think we have a lot of people who are yet to join, but nevertheless, there are people who have already joined, and we should not punish them for, being on time. So I think we should start.
Yeah, I think we are 53, so let's get started with the introductions. Just be mindful that you keep on letting in people who come in later too.
Yeah, we'll keep letting in people.
Yeah. So Tushar, can we start?
Please.
I'll start off by introducing you, and then you take over and you can introduce Aditi.
Yes.
Yeah. So thanks everybody for joining this webinar by the Meghnad Desai Academy of Economics. And we know we have a mix. We have students from the academy, we have alumni, we have working professionals, etc. So I'm not even going to pretend I'm addressing a particular demographic. So I'm going to introduce Dr. Tushar Poddar, who's the founding director of Meghnad Desai of Academy. That's his designation, but I really call him the moving spirit behind the academy. And in my position as Director of Academic Programs, I draw a lot of inspiration from him. He's a macroeconomist of world renown, and suffice it to say that with all the economic turmoil that has been unleashed by what's going on in Ukraine, the one person at the center of things in terms of the economic turbulence on the continent is Dr. Tushar Poddar. Okay, so he's a PhD from the London School of Economics. His background is he's been an economist at the IMF. He was chief economist at Goldman Sachs in India. He had the designation of managing director. And today, while he tries to help the world to deal with what's going on in Ukraine from an economic and finance point of view, he does that in his position as micro strategist at Wellington Management in London. With that, I hand over to Tushar and he'll introduce us to Aditi, and then we are on our way. Tushar, over to you.
Thank you. Thank you, Amlesh, for that very kind introduction. It gives me a lot of pleasure to introduce our speaker today. Our speaker today is the Vice Chairperson of DSP Investment Managers Private Limited. She heads not only sales, marketing, but is also heading the entire digitization effort in DSP. She's really passionate about the financial sector. She has over 2 decades of experience in the financial sector. She's also really passionate about education. So she's building out the education platform in DSP. Her background is that she joined Merrill Lynch in 1998 in New York, primarily working in M&A activities. Subsequently, she worked as part of the fixed income sales team, and then joined DSP Merrill Lynch Fund Managers in 2002, where she worked on various projects, including an offshore fund for foreign investors, which I also know she's really passionate about. Our speaker today is also a trustee in the Hemendra Kothari Foundation, as well as the Wildlife Conservation Trust. She's written a bunch of articles on financial markets and wildlife, which is really, really interesting. And I would encourage everybody on this call to read. Apart from being all that, she's also an independent director at Godrej Agrovet, and she serves on the board of Dasra, a leading strategic philanthropy foundation. She's also an advisory board member at the British Asian Trust. Our speaker today holds a Bachelor of Science degree in economics from Wharton and an MBA from Harvard. So her pedigree is really top notch. But really, I know her as a friend. I know her as somebody who's really passionate about both finance, about women, and financial literacy amongst women, but more importantly on education. So, she really brings a multitude of interests, and her experience is really something that we can all benefit from. So, please join me in welcoming Miss Aditi Kothari Desai.
Thank you, Tushar, for this lovely introduction. I am blushing. I don't know, how much of all the praise I deserve. I always blush, but thanks again. And, to the students out there, I'm so excited to be addressing you all. This is something that I feel is a topic that is never discussed when you're a student. And I frankly feel that it should be compulsory as, a class that you do from high school all the way to the time you graduate. It is so important that people forget about it. And what we do worst in life is we manage our money the worst. What happens is that we all, like all of you all, want to, really want to go out and get a job. That's great. When you all make the money from the job, also you all feel great. And then you spend the money, which is fine. The problem is the money that you save, which you should, you never do justice to that saving if you don't invest it and you don't invest it correctly. So today I'm not going to talk as much about the details of the investing, because all of y'all are probably at different levels. I'm going to talk much more about why you should be doing this and why you should be doing this earlier. And I want to open it up a lot to question and answers. I do want to address the, women as well, almost separately here. Women, most women, after they get their, jobs, they leave their salaries up to either their husbands, their fathers, or their brothers. In fact, even we have only 30% women investors at DSP. And what's worse is, I don't really know if that number is even true. In fact, it's not, because when we call the number that's put there, the husband picks up the phone or the father picks up the phone. Or if the daughter picks up the phone or the wife picks up the phone, she gives it to her husband. She says, I don't know anything about this, you talk to him. Which means if I really have to look at the number of investors that are women, it's about, who are making their own decisions, it's like 15% or less. And that's really something that I would like to change. And you all need to change it from your first salary. Why should you, be investing your very first salary now to all of y'all? Because there is something called compounding. When you put your money in, that earns interest, that interest earns more interest, that together will earn even more interest. And if you look at something called the rule of 72, you take 72, you divide it by the rate of interest that you're getting. That many years, your money can double. So the longer you invest it, given that, you invest by 22, 23, the longer you have time for it to double from the time that, you will live. And today people are living, all of us probably will live over 85 years. Another reason you need a lot of money in your retirement, in your zero salary life. Please remember, you're getting the salary now, but one day it'll be zero salary. So you need to have enough of a pot at the end of that where you can pay for your health expenses and where you feel still financially independent. So I'm just, sorry, I'm going to skip here. Have
you shared your screen, Aditi?
Yeah, you can't see this?
I can. Yes.
Okay,
Let's go on.
Okay, one other big reason we need to really focus on investing and investing soon is because of inflation. You all are students of economics. You know what the rate of inflation today is. And I don't even know if I really believe that rate. But anyway, it's around 5%, they say. And sometimes what we spend on, the inflation's even higher at. Now, if you're going to leave it at the bank, which is giving you about 3.5%, 4% in a fixed deposit, when inflation is 5%, you're losing money over time. So please remember, the biggest goal of investing is to beat inflation and beat it early. Otherwise, your money is dwindling. And the longer you leave it to dwindle, the faster it will dwindle. Similarly, the more you invest, the faster it will grow. And the earlier you invest, the more it will grow. So a house, for example, today, or 70 lakhs, after 5 years will be 94 lakhs. Cost of education is something that is really galloping. We all know that. You all are students. Today, 8 lakhs, maybe after 10 years, 21 lakhs. And today, 5 lakhs, at today's inflation rate, inflation is considered at 6% for buying the house, 10% for education and health, because that's where it's been. And today, what you pay 5 lakhs for health is 13 lakhs after 10 years. So you better be investing in a way that you're getting more than this. As I said, only 33% of women make their own investment decisions. Here is a rule of thumb. People ask me, well, how much should I save when I get when I get my first salary? Well, typically, this is how it's going to be. 50% you will need for your groceries, for your rent. When I first got my salary, guys, I was in America. And I'm not counting my internship things, but when I got my full job and I got my salary, I remember the regular salary check, I had to just sort of write at the back of it. And remember, it was physical those days, and give it to my landlord for rent. It's only really my bonus that I got at the end of the year. Could I do something really more fun with it and save and invest? So, and let me tell you guys, I got my bonuses when I worked in America in 99 and 2000. Those were booming years. What did I do with it? Because I was doing banking, I was doing investment banking within banks and insurance companies. What did I do? It sat in the bank because I had no time to talk to a financial advisor, to understand what is going on in the market, to do my own research because I was busy working. And that's going to happen to you all. Imagine in 2000, when I got my final bonus, when the market was on its way down, if I had invested, what that money would be worth today. But I didn't do it. It sat. And that's not something I want you all to do. Please remember, yes, half of it will be on needs and survival. And then 30% will be on the fun stuff, shopping and watching movies and restaurants and bars and entertainment, taking your girlfriend or boyfriend out, giving them gifts. All that comes in the 30%. 20% is what you should always aim to save. And I tell people, when you get your salary, try to see if you can put 20% of your annual income, put that aside and know that that will always be saving. So let's not go first, 50, 30, and then whatever's left. 20, then 50, then the 30 is, if you think of it like that, you will be able to save more for investment. And remember, savings is not the same as investment. The other thing that you need to take care of when you start, you need health insurance. Again, please do it when you're young. Okay, and I will put health insurance in this blue bucket. It is a need. And please do it when you're young because your premiums will be low. We all start much later and our premiums get really high. So start your health insurance low when you are younger. So if you have any dependents, you will be married, you will get married, you will have dependents, you'll have children eventually, you have old parents. Get life insurance, it's called, and term insurance. Please don't get what is called unit link, investment insurance. It's really no point doing that because they charge very hefty fees and they bury them and you won't even realize you're paying them. So they say, oh, but I'll also do your investments for you. No, let the investment company do your investments. You use the insurance company for your term insurance, as they call it here. And identify your needs, not just your wants. Understand your risk appetite. This is very important when you guys start investing. So I'll give you an example. In risk appetite, there are two things. One is called risk tolerance and one is called risk-taking ability. Now, at your age, you all will graduate at around maybe 22, 23, 21, some of y'all. At that age, your risk-taking ability is high because you can make mistakes along the way. Let the market be down for a few years. What does it matter? You're living till 85. You're young. You can take the risk. You also, a lot of you all may not be married. So again, you have no real dependents. Your parents are still probably relatively young and are making their own money. You have absolutely no dependents. So you know what? You can take that little risk. So risk-taking ability has to do with the amount of money you're earning. Y'all are, I'm sure, going to get good jobs and graduate from good universities. So you have some good risk-taking ability there. You have no dependents, good risk-taking ability. And if you don't, you will have some debt. So that actually takes your ability. Some of you all may have some debt. So that may take your ability down a little bit. So, that you have to be a bit aware of. And overall, I feel your risk-taking ability will be higher than the average person at 35. Then becomes your risk tolerance. Okay, so your risk tolerance is something I'll give you an example. I may be really afraid, right? If the market goes down 20%, it's my hard-earned money. I'm sweating. I can't deal with it. I don't want my money to go down. I really just can't deal with it. There'll be someone else, maybe Tushar. He's like, listen, I'm really seasoned. I don't care if the market goes down 20%. Let it go down even 50%. I'll buy more. Okay, I know in the long run it'll go up. I'm so confident. There'll be someone who says, I don't mind it going down maybe not 20%. I don't mind it going down 10%. I won't do anything. I'll just sit tight because I know in the long run it'll go up, but I don't want to go down. I can't stomach if it goes down too much. But different risk-taking abilities, risk-taking tolerance that people have. At the same time, you have to balance it with your risk-taking ability. If I'm an 80-year-old person and I say, I want to bungee jump, so my tolerance for risk is very high, can I let him do it? Absolutely not. So his risk-taking ability is low, but his tolerance is high. So he has to balance that, right? Again, at 80, he's probably going to live, hopefully 10 more years. Can he take crazy risks in the market with his money? No, because he has a few years to live and he needs that money probably. And he's probably in retirement and probably doesn't have a salary. So you need to balance your risk-taking tolerance with your risk-taking ability. Now, if your risk-taking ability is high, but your tolerance is low, well, you guys need to find someone who can get the courage to get your risk tolerance to be a little high and put a little more in the equity markets, because you all are young and there is a lot ahead of you and a lot of time ahead of you. And then you have to plan your asset allocation. So according to your risk profile, usually a good financial advisor, the DSP site will now have this tool where they give you a risk, they give you an asset allocation. So for your risk-taking ability and your risk tolerance, I will give you a score, and accordingly, I'll take, say, so much in equity, so much in fixed income. And I'll tell you that, and which funds within that are good for you. Little bit of international, a little bit of a more aggressive equity fund, a little bit of a less equity fund, depending on your risk ability and risk tolerance. So that is called an asset allocation. No one is going to say put everything in equity. No one is going to say put everything in fixed income. That will not cut it for you, especially if you have a goal. Oh, I want to buy a house in 10 years, and I have the risk-taking ability, but I don't want to take any risk because my tolerance is low. But you're not going to get to your house then. So we need to balance everything for you. And DSP will be coming out. So keep an eye out on that with a tool which will tell you exactly what your risk-taking tolerance and ability is, and which, what your asset allocation is and what you should invest in. But asset allocation is very important. Don't go by what your friend says. Ye fund chal raha hai, let me put money in that. Wo fund chal raha hai, let me put money in that. Oh, don't put it in this, FDs are the best for you. I mean, people are biased. They're going to give you biased advice. Another thing, when you invest, you have to have no emotions. And you have to look at your unique risk profile, and which means risk tolerance and risk ability, which will be very different from your friends. So please, you need to get the inner strength and confidence to know that that is what you're going to do and not going to go by hearsay. And you have to keep evaluating your plans. Today, you may not, you may have high risk-taking ability, but tomorrow you may have more dependence. You get married, you have 3 children. So you have to balance it. At the same time, your salary may go up. So, it may balance that out. But what if it doesn't? So we have to keep evaluating our plans, maybe annually. Once you start the financial plan, though, don't stop it. And girls, your man is not your financial plan. Please remember that. We would like you to do this on your own. And where can you invest? There are so many options, as I said: mutual funds, individual stocks, bank deposits, PPF, bonds, gold, property, and many more. Oh my God. And here is how they've done over time. So in the last 1 year, the Sensex, which is the market, I'm taking the B.Sc Sensex of 30 top stocks, they've done the best. And over 20 years also, they've done the best. But let me tell you, in the 1 year return, this can be even down 22%. It was down 50% in 2008. So remember, markets will fluctuate. That's the only truth. But look, 20 years means it has taken into account the 2008 fall also. And we're still at 15.5% CAGR, which is mean on average return. Guys, on average, this means someone says something has given you 20 years on average return, doesn't mean that it'll give you every year 15%. It could be down 20%. It could be up 100%. On average, it has given you 15%. Please remember, when someone tells you something, it means on average, calculated in the compounded annual formula. PPF is given about 7.1%. And my one year returns, by the way, are not end of the year. It is literally as of March 30th, March 29th that she's done it. And but the return on that we could get best on gold, for example, was also latest. But PPF and fixed deposits and savings account, we've given you more of like year end. So these are very interesting to understand. Gold has done really well, actually, guys. Doesn't always do well. In the long run, gold actually has not done well. And Tushar will no better person to tell you than that. But in the last 20 years, actually, it's had a very good run. So just to give you an idea, just look where fixed deposits are, guys. And we just have to be careful of that. That's all I'm saying. And look at where savings accounts are. Please never, never, ever, ever, ever leave it idle. And markets are always going to fluctuate. This is a fact. I'm going to make this larger, guys. Do you all remember? I don't know, your parents will tell you, oh, markets are the worst. Look what happened in the Harshad Mehta scam. That's like a little blip somewhere. The big, here. I mean, I'm going to put my, about like here. When Rajiv Gandhi passed away, here's a scam. This is one scam. This is when the dot-com bust happened. Dot-com bust was here. This is when the big dot-com bust happened, and there was yet another Ketan Parekh scam or something. Then we had, 2008. Here is what happened. Another scam. All these scams come out then. And this is where the Sensex has ended. There's even COVID, and this is only updated to end of 21. But my point is that, and look at, the Sensex even crossed 50,000. My point is markets are going to fluctuate. In the long run, equities will do well. You have to be able to stomach these things. This is where your risk tolerance will be tested. So here is something, mutual funds, because that's what I know best. We have a Flexi Cap fund, the DSP Flexi Cap fund, which is our longest fund. It's going to finish 25 years. Okay, I'm going to compare it to the Nifty, which is our regular index, which is the top 50 stocks. B.Sc was the top 30 stocks. I'm going to show you the top 50 stocks. This fund has done better, not always, but if you look at it in the 25 journey, it has done very well compared to the Nifty 500, which are, the top 500 stocks. And remember, this fund had almost 6 years of no return. If you look from here to here, it had negative returns for 3 years. Imagine your NAV, your price of your fund is falling. The good thing is it's a bag of different stocks, right? That's what a mutual fund is. Mutual fund is something where you have a basket of secure stocks together. So you're not only dependent on one stock going up and down. And if one stock goes dud, you have a fund manager who changes things for you, who looks after your money, right? And your risk is therefore diversified in many, many stocks. It's similar with the 500 stocks as well here. But, this is maybe about 50, 60 stocks that the fund manager chooses. We've had a huge fall in this fund as well. Yet, this fund is up 85% from the time it started its journey. So this, your zero, this is time zero. You can say, if you put, I would say, your 1 lakh put back then is almost, 80 lakhs today. We even have gold fund. So if you want to put it in equity funds, that's what I showed you. There's an option of what is, commodity funds like gold. People are coming up with silver funds. We're coming out with a silver fund. And gold has done really well, as you've seen. But look at how it had periods where it just was flat. So you have to know that you need a basket of things that complement each other so that you have more stable wealth growth over time. You will have different mutual funds in the market to suit different goals. So if your goal is, I have money in my savings and I want to do something with it, but I don't want to take too much risk. Okay. And you probably need the money soon. Your time horizon will ask you, how much time do you need the money in? Oh, within 6 months, I want to spend the money also. So then you'd go for money market or liquid funds. If your goal is, my goal is to spend this money soon, and I still don't want to take too much risk, but I still have, 1 to 6 years, I'm okay with it. And so we'll still give you, fixed income mutual funds for you because it won't fluctuate too much like you saw the markets. But if you tell me I can absorb risks, I don't need this money, at least for 6 years or even more, 10 years is great. It's for my child's education. I'm putting it for my, kids' marriage when, you have kids, or it's for my retirement. Then definitely put it in equity mutual funds and don't look at it till you need it. So there are many ways you can invest into a fund in India now. So I'm telling you a little more about mutual funds because I know that best. You can do it through a systematic investment plan. That means you guys will be getting salaries every month. The best way to ensure that you're going to be saving is making sure automatically from that salary, the money is going into your asset allocation basket of funds. So you can have a little bit of that money going into fixed income, equity, gold, whatever you choose according to your risk profile and risk tolerance. And that is called a systematic investment plan. It can be directly debited from your bank account and it can go into your savings. And as your salary increases, you keep adding to that. To the point, as I said, 20% at least of that salary check should be coming into some kind of savings. Of course, you can also do a lump sum amount and put everything, but I would suggest, because you all are going to get your first salary and you're going to be getting salaries, doing it in a systematic way is best. Also, the reason doing it in a systematic way is best is because we don't know how the markets will do tomorrow, day after. Don't wait for the opportune time. This will average it out for you. As I said, very important. One day you will retire. One day you'll have a zero salary life. Don't compromise your lifestyle, whatever happens. So keep a little bit of pot. It seems really far away. It seems so boring to think. You don't even want to think that you'll be looking like these guys. But it will happen. So, and you will live longer because that's just the way medical science is advancing. And so we have to just keep it in mind and just invest for the long term, at least part of your money. Another very important thing, the first mutual fund you should be investing, and this is when you want the long term, is an ELSS plan, which is your, it helps you save your income tax. So up to 1.5 lakhs a year, you can save. So if your salary is say, 10 lakhs, 1.5 can be saved by just putting it into this fund. You have to lock it for 3 years. The gains you make on this, that will be taxed at 10%. But even that you have a bit of a concession because up to 1 lakh, even that is not taxed. So there are all these little things that you need a financial advisor that can really help you through this. You have to, it's locked in for 3 years, but doesn't mean you should withdraw in 3 years because it's equity, you must leave it long. So if you want to be a good investor at the end, what are some of the traits? Diversify, like I said, can't put all your eggs in one basket. Don't put everything in equity or debt or everything in a single stock or even a few stocks, because you don't know. Get a professional to do it for you and have a mix of debt and equity and hybrid funds. Hybrid funds are already mixed for you in a certain proportion of debt and equity. And why is that good? Is because it keeps balancing itself and you don't have to pay tax every time it balances. So hybrid funds are good for that. Emergency planning, you're going to need like suddenly some cash. And so that would be liquid funds. Invest in an equity fund that will help you build wealth, I said, but only if you don't need this money for about 8 years, which you can do because you're young. You can keep some money that you will not need for 8 to 10 years. And if you can stomach the fall, as I said, sometimes possibly, it could be, this was only once I've seen this fall of 50%, but it has happened once of your invest amount. But the thing is, if you don't withdraw it at that time and you leave it invested, it can even bounce back. In fact, when COVID and all the lockdowns were announced, the market went down almost 30%, and then it bounced back very soon. So the people who took it out, they missed on the big upswing again. You don't want to do that. You've got to have patience. Start an SIP and top up your SIP as your salary increases. And invest more when the market falls. Don't have only one fund. Don't invest in equity funds for a short period. Yeah, you could get lucky and you could get a windfall and suddenly the market goes up 20-30% a year. You feel very excited, you take the money out. But what are you going to do with that money? Unless you need to spend the money. So keep it if you need it. If keep your money in equity funds for a long period of time, let it compound. What did I say? The 100 becomes, say you do well, 110, the 110, you get another 10% on that, you get another 10%. Remember, time is your friend here. The compound interest formula is 1 plus r raised to t. Your t is the exponent. So keep it in mind and make sure you invest for the long, long run. Don't ever sell when the market is down or the fund NAV has fallen. Please don't do that. That is the worst mistake you can make. We, in fact, classify investors as being sensible and non-sensible. And the people who sell when the market is down, this is my machine learning part, classifies you as being non-sensible, because then we realize we have to market to you in a different way, talk to you in a different way, give you different products, understand that your risk tolerance is low, etc. But you guys should not aim to be in that bucket, please. And don't chase returns. Oh, this is something all novice investors do. If that fund is giving me the highest return, then I will run there. If they're giving you the highest return because that has happened in the past, it doesn't mean it's going to happen in the future. So please keep that in mind. You need to go with a fund manager that has a good process, is a good brand name, someone you can trust, and don't go for just what has done well in the last 1 year or the last 3 years. There is no guarantee that will do well in the next 3 years, the next 5 years, the next 10 years. Because if you're going to get into equity, you want to get in for the next 10 years. And how can you transact? Well, there are 3 things. One is you need to do your KYC. You need your, and this is for mutual funds. You need your ID, address, proof, and photographs. You can do that now in any sort of, you can go to the DSP app and do that. You can now do that, Grow and your ET monies and all of those. You can go to a financial expert. There are many, financial IFAs. You can go to your bank and ask them. I like independent financial advisors. I think they have your interests more in mind than maybe a bank RM who will be there today and won't be there tomorrow because they get transferred so fast. And you have to ask also the fees. When a bank does it for you, they are incentivized to sell the product that gives them the highest commission. So just be a little careful. And then online or physical, you decide on that, what you're more comfortable with. Of course, your transaction should be done online. We should get rid of all paper and physical, but you may need some help, like a physical person helping you, so therefore you can go to an advisor. Now you have, a lot of the apps, as I said, DSP is coming up with one, risk assessment tool, which just assesses your risk, tells you what to invest in. So you download the app, you do your KYC, you fill in the risk assessment. It tells you which basket of funds to invest in, click a button and it's done. So you want it like that. You don't have to have a physical person. And, if usually when your investments are more than X%, usually people will call you from the firm to know if you need any assistance, if they know you've come without any. And never stop learning more, please. We have, DSP actually has started something called dspim.com/learn. It's a learning library. You can say you're a beginner, you can say you're an intermediate, you can say you're advanced. And, it takes you through different modules. I've had my 14-year-old cousin do it and get to the advanced stage. I've had very advanced investors coming and learning more just at the advanced stage. So do go and check it out. And for women, we have, you can follow us, all of y'all can follow us at DSP Mutual Fund. Just keep learning, and please know that it's your money and it's your hard-earned salary and you should be in charge of it. That's it from me. Very open to questions.
Yeah, Tushar, I can help moderate with the questions.
Please go
Yeah.
ahead. I thought that was excellent. So thank you so much for that. I think lots and lots of learnings come out, but I think there are some questions on the chat. So yes, please go ahead.
So Aditi, Humaira Patel has a very, very contemporary question. I mean, it
Tell
will
me.
be my question. What's your opinion about small case? She also wants to know your opinion about index funds, but I think small case is really contemporary.
So, we love small case because, actually DSP has an investment in small case. So I feel it's almost a cousin of ours in some way, and it's a very contemporary cousin. Small case is good, but it gives you a basket of stocks. You have to take much more care of it than a mutual fund, which in one click gives you a basket of stocks. It does all the balancing for you. Small case will tell you when you have to balance. So you have to do a little more work with small case. And it is a basket of stocks without being called a mutual fund. But they're doing very well. And if you want to buy individual stocks, please buy stocks in a small case, because then you're not buying individual stocks. In addition to that, of course, you can buy mutual funds, debt, equity, everything. But for sure, small case is great, and they're doing a great job. So does that answer your question?
Yeah, I think that answers my question. Now, I'm not sure whether the participants can, attendees can speak. I think they might be muted. So, and next, Dhritiman Das has a very philosophical question, and maybe even Tushar would want to take a stab at this. So, he's questioning the financial system, the, I guess, capital markets. He says it's rooted in capitalism and has, in his opinion, it seems like he believes it can have an adverse social impact. I think his question is finally amounting to asking whether, capital markets finally amount to more harm than good.
Why? I mean, people have built their wealth on capital markets. I'll tell you something very interesting. Again, with mutual funds and making it easy to invest through SIPs, my cook here has invested his money. And I'll give you another example. I had, one day I had a knock on my door, and it was my security guard, which was up, my watchman. He comes up and he said, हमको आपके company में पैसा लगाना है. So this is what my cook tells me. He's come to tell me that. So I said, they think they're investing in my company, but actually it's a mutual fund. I said, okay, क्यों? क्योंकि उनका friend ने लगाया था और अभी उनकी बेटी की शादी हो गई, और 10 साल पहले लगाया था, बहुत पैसा बनाया, बेटी की शादी हो गई, अभी उनको भी लगाना है. So I said, very good. And he wants to put in his kid's name. I said, very good. Then my cook asked me, why not me? I said, of course. So from his salary, we started an SIP. Every day he shows me how well he's been doing. He made everyone else in the house, all the workers in the house, from the, gardeners and everyone was putting money in this fund. Finally, I had multiple bells ringing because I had this now watchman had gone and told all the buildings around and their watchmen. So everyone started knocking on my door and asking me on how to invest and where to invest. And that just feels it's heartwarming. Okay. And we get these mails so often. I put I didn't have much money, but my child is going to Harvard. Or, I put my child through school and through, a best college because I invested in your fund. And so I don't see any capital harm there.
Okay. Yeah. So I'll go on to the next question. Kaustubh Jadhav, one of our students from MDAE, in fact, a nice, again, very topical and contemporary question about investing in foreign stock markets. And everybody knows there's a lot of new apps and applications. He's asking, is it a good idea? But I think what really everybody would like to know is there any care that Indian citizens should be taking when going through these apps and investing in foreign stock markets?
Yeah, I know that there are a lot of apps like that. Because you have to do your own research on these foreign stocks. So make sure you've done really good research on them. There are ETFs you can buy, right? You could just buy the S&P 500, but then you can buy that in India, through people who are selling that. Nifty, a NASDAQ ETF. DSP also has a fund. It's a global innovation fund, which right now we have only the semiconductor index and the NASDAQ in there. So it's much easier to do than, the international stuff where you have to open a bank account abroad. And they help you through that, but there are many more steps. And then you buy one of these baskets of securities. So why not just buy the mutual funds in India where you have a variety of international funds now? You have US funds, you have global funds, you have Asia funds, you have Europe funds, and you get exposure to these markets. Of course, you want to buy individual stocks, go through these apps. There is an LRS, you do it through your, foreign money limit, which is $250,000, which is plenty. So you can do that if you'd like. But you must invest internationally. Yes, from this age, don't put all your eggs in one basket. Don't put everything in India. But when you invest abroad, unless you're very confident to do stocks, please buy a basket of securities.
And a corollary question, Aditi, one of our students asked me recently. So when Indian citizens invest in foreign stock markets through funds or whatever, is it also de facto a way of having some of your holdings in foreign currency? So when you sell them, okay.
Yes, so, it is because because those funds are listed in dollars, right?
Mm-hmm.
So when you convert it to rupees, and if the rupee depreciates, you actually benefit.
So when one buys them and finally sells them, one continues to hold one's funds in foreign currency unless one decides to repatriate them.
Yes, you're right.
Okay. Yeah, so that was Kaustubh, and many more questions have come in the meanwhile. Let me just go through them. Okay, so Abhishek Sakharkar has a very, very operational question. And what happens if he stops his SIP, which I guess he got going due to financial problems, and then he wants to continue after a gap?
So there's something called pause SIP function, guys. I know DSP has that. When you pause your SIP, it automatically pauses for 6 months, and then it automatically starts after 6 months. You can repause it if you want.
Okay. Yeah, so I thought that was a very operational question.
Yes, no, but it's important. All these questions are important because it's possible and it makes life easier for you.
Here's a really interesting question. I think it goes to the fundamentals of what you were saying. Unfortunately, the attendee is anonymous. If I have an education loan that I can pay off within a year with my current salary, should I first hurry to pay my loan first and then start investing? Or I guess he's asking whether he should go in for a mix. What should his
Very
her priority?
interesting, because you have to know whether you have to see the interest of your loan and what you expect in the market. If you ask me, and again, what your risk tolerance is, I'm okay to take the risk. I'll invest in the market, which I feel in 3 years will give me, on average, 15 or whatever, 12%. And my loan I got for 6%. I can stretch it and I'm making some money there. So, I'm confident. I have good risk appetite. But if you ask someone like me, I would like normally to first get rid of my loan and then invest, if you ask me. Or invest a small amount in the market and pay your loan off simultaneously. So more money towards paying your loan, less money towards investing.
Okay, and a really interesting question from one of our students, Karan Wadekar. Essentially, it boils down to saying that the CAGR slide that you showed, Aditi, real estate was missing from there.
I know. And I purposely did that because we used to have it, but we never got the right number to show you for real estate, because real estate is so different everywhere, right? The real estate in Bombay is different from Delhi, is different from Bangalore, is different from Gurgaon, commercial. So we used to have a number in there. I purposely took it out because I don't know how representative it is, but listen, I can tell you something about real estate as an investment. Guys, lot of negatives about real estate as an investment. If you need a house to stay in, please buy it. You must buy it. You make tons of money, you want a holiday home, please buy that too, to enjoy it. Real estate as an investment because you want to rent it out. No one takes into account brokerage fees, even in any returns that I'm giving you. There's when you compare it to a mutual fund or an index fund, the fees are always counted there. Here, you pay a broker when you buy something. So then you buy it. Then what do? You have to rent it out. You pay another broker, you rent it out. When you rent it out, you have to maintain it. So you have a maintenance cost, which no one looks into account, again, into your return. You maintain this thing, right? If something breaks, painting, at least painting, also the fitting of everything before you even rent it. Then you rent it out. You pay the broker for finding the tenant. Now, what if something happens with the tenant? What if he runs away, doesn't pay the rent? You have all those risks going on. And then the tenant leaves. Again, you have to go and find another tenant. What if you don't find a tenant in time? Sitting idle again, your property? Please remember there are a lot of risks. And remember, the income you're getting from the rent is charged at the full income tax bracket. Whereas anything you put in the equity markets or in mutual funds will be given a tax benefit. Equity mutual funds or equity direct markets, you only charge 10% long-term capital gains and 15% on short-term. Whereas if you're making good money, you could be charged about 30% on your rental income. So please be aware of that. Just remember that real estate is not as easy as it looks. Remember legal fees, I didn't even come to those. So many legal fees to actually buy the property, and whatever you need to do, papers, paperwork, physical documents. And then if you have any issues with your tenants, more legal fees. Then if you want to sell it, it's not liquid tomorrow. You don't have liquidity. So please remember, these are not, looking at real estate as an investment is tricky unless you're a builder yourself. And it's a different matter.
Okay,
that answer? Yeah.
Yeah. I think, yeah, I know where Karan is coming from. I think that more or less answered. Sakshi Hiremat has an interesting question. It's interesting for me, but I think the answer to that could be a research paper or a dissertation. I'll read it out anyway.
Sure.
She says, as one's long-term plans change over time, what steps should one take to alter investment plans to fit that?
Well, I said, right, your risk appetite and your risk tolerance will change depending. If you start getting more dependence, then your risk-taking ability goes down. But if your salary increases disproportionately upwards, then you don't have to worry. Then your risk-taking ability is still high. If your and your risk tolerance may change over time. You may be very scared in the beginning, but as you've invested in the equity markets, you've realized it's not such a bad thing. and your risk tolerance goes up. Or maybe if you have a bad experience, your risk tolerance goes down, but that shouldn't happen because you should know that you're biased in your mind. But my point is that your risk tolerance will also change over time because of circumstances, and your risk-taking ability may also change. Maybe you go into debt, sadly. We never know. Then your risk-taking ability again goes down. So accordingly, your asset allocation will change. That's why I said you have to review this every year.
Yeah. Okay. Now, my student Raj Ravaria has a real probing question, and I wouldn't expect anything less from Raj.
Yes.
How important is it to check for the fund manager's philosophy before investing in their mutual fund, especially in actively managed funds?
You are amazing. You are amazing, because this is extremely important that he actually has a philosophy, B, that he's sticking to what he's saying. Very important. And that you believe in his philosophy. Okay? Just because, there is something called luck in the market. The guy's done well in the last 3 years because he's luck. It's luck. You don't want to invest in a manager that is going with luck, because tomorrow his luck can also change. The stars will change in the sky. But if he has a proper process that is researched and looked at, please go with a fund manager like that, because he is emotionless. He's sticking to a process, and the process is really thought about on why he's buying a certain company. And in the long run, he will do well. The people that have done best in this world are people with processes. The person who has the best process is Warren Buffett. He has the longest and best track record in the world.
Yeah. So just to give you an idea of what kind of a person Raj is who asks this question, Raj is a guy who has been sure from day one that he wanted to do finance, but he did his B.Sc physics, not because he loves physics, but he wanted the mathematical background. So that's the kind of person Raj is.
Raj, I'm very open here. Send me an email. A very, very interesting question. And the way you think has really impressed me.
Actually, I'd like to comment here as well. I think this, as Aditi mentioned, so I spend 50% of my time in thinking through my philosophy and process when I'm investing. That is how much, even after 25 years in financial markets, because it's so important. As Aditi said, whether you have a process which makes you go through the downs and ups is so important. And I think that you can use that not only in investing, but also in life. I think it's a life lesson that do you just react to changes? Do you react to downs? Or do you have a process which is set, and that helps you? And when you talk about philosophy, it is, how am I investing? Am I looking for long-term gains? Am I looking for value? Am I looking for growth? Am I looking for mergers and acquisitions? What am I really looking for? And I continue with that process no matter what happens, right? Whether it's a down market or an up market. So this is a really, really important point that, I think Aditi answered really well and emphasized it. So great question, but I just want to highlight how much time I spent in my philosophy and process, because it is so important for investing.
Amazing, Tusharan. You must have heard of the famous saying by Abraham Lincoln, saying that if I had 6 hours to chop a tree, I'd spend 5 hours sharpening my axe.
Yes. It's amazing.
Okay. And finally,
and this is also true for economics. And as you guys think about problems, as you start getting employed and so on, spend 5 hours out of the 6 that you have in thinking about which framework you're going to use.
Yes.
How are you going to try to solve the problem before you solve the problem? Learn about the framework. This is the framework that I'm going to apply. This is the axe I'm going to use. This is how sharp my axe has to be. And then the solution becomes really easy. Then the actual doing of it becomes much easier. So planning or having a process for everything that you do is so important.
Yeah. And finally, Abhishek Sakharkar has asked the question that I was really, waiting for somebody to ask. I call it the baby elephant in the room. What are your views on cryptocurrency?
The wrong person, guys. I just can't understand it very well. I'm in the Warren Buffett camp. Charlie Munger camp, and it's very controversial. But I'm in their camp, and maybe you can YouTube and see what they say. But I think exactly the same. One of which is I don't want to help currencies that today are helping kidnappers. Um, you know, when there's no regulation to a currency, it makes me nervous. And the minute there is regulation to the currency, it no longer has the financial freedom that Bitcoin today offers. Blockchain, on the other hand, I love the technology. And a lot of people mix up blockchain and Bitcoin. Blockchain is going to have a huge future, and people will have to build on it. Bitcoin is just one of the outcomes of blockchain. And, I need to study it more. Right now, I'm not in the positive area.
Yeah, I'll just add my 2 bits on this. I just sent a message to Tushar before this webinar. I finally met somebody who has actually mined a Bitcoin on his own. It's an old friend from the US who came down, but he did it only for the technological kick. So he actually has a few satoshis which he has mined on his own. And the other thing I think about Bitcoins and blockchains is the energy consumption. Yeah, apparently 2000 blockchain transactions consume the same amount of energy that a wide-bodied aircraft consumes in a transatlantic flight. I think that's something that everybody should keep in mind.
And also to know that there's so many villages, so back to the capitalist question, that there's so many villages in India right now that are just need that power more than us producing Bitcoins.
And Abhishek is asking another question on something that I don't understand. Your views on REIT funds. I don't know what they are.
Or REITs.
Yeah.
There are some international REIT funds. Again, I'm not very familiar, but it's a good way to get real estate exposure as opposed to buying real estate. That's something I'll tell you. What my views on real estate and REIT today are and where I think it will be in the future, I'm sorry, I'm not the expert. I won't be able to answer that.
Okay. And again, this question comes up every time. It could be you or Tushar. Could you express your thoughts on gold as an investment and whether gold bonds are recommended to actual physical gold holding?
Tushar, I'm going to give it to you. You're the economist here with a long-term view on gold.
Yeah, conveniently. So I think in a well-diversified strategy, yes.
I'm here for you, by the way.
There we go. I think in a well-diversified portfolio, there is always room for gold. I think, it should be a small part of your, portfolio. I think that gold has typically got less risk than equities. And given your age and all the things that Aditi said, at this age, when you get your salary, your first paycheck, if you're investing, you can take risks. You can put it into equities. And that, I think, has high returns and high risk, but over a long period of time. But as a diversification strategy, I think gold should have some part of your portfolio. I would actually recommend that you have, gold ETFs or bonds rather than actual gold holding, because it's the physical aspect of caring for its security, etc. You don't want to, have a gold holding that keeps you awake at night, whether it's stolen or whether it's kept safe or not. It's much easier to put it in a financial form or a paperless or a non-physical form rather than have it. And you can see, as the chart shows, returns on gold.
Yeah. So, I mean, my 2 bits would be inflation is going to go higher, and gold is a hedge against that. But inflation doesn't last forever and ever. Let's hope in our country it doesn't, and abroad it doesn't. And at that point in time, gold goes down. Then it's important to have a little gold just to stabilize your portfolio. But can gold build crazy amounts of wealth? No. Can stock markets build crazy amounts of wealth? Yes. So keep that in mind, and therefore keep gold on the side. Women, of course, Tushar said no physical gold. I don't believe that. You can have a little bit of that too. at the right time.
Okay, I'm fast forwarding to a question by Amol Dongre. He's one of our students and keenly interested in finance. Chartered accountant, he's doing his CFA, etc. So I'm really interested.
Yeah.
So he's asking us, isn't it better to invest in a portfolio management firm where I get access to a fund manager PMS, rather than a mutual fund?
Yeah, so there are two things. If you put it in a PMS, you still have a minimum amount of 25 lakhs. There's some very good PMS managers I know, but they never talk about their fees and their after fees performance. And it gets very non-transparent. Also, a lot of them don't have long track records. So you have to ask the right questions. So if you have 25 lakhs to invest and you want to invest it, plus there's no SIP there. Want to invest it in their PMS, one time lump sum, you ask them questions. What are your fees? What will be my returns after I pay your fees? What will be my returns after taxes? Because they don't necessarily get some of the tax advantages that mutual funds get. Mutual funds as a whole don't pay tax. I can keep trading in a mutual fund and I have to pay no tax if I'm a mutual fund manager. And then at the end, you pay the tax. When it comes to PMS, it's not the same. You pay tax per transaction. So, and he pays it on your behalf. But still, it makes your expenses a bit higher. These are little subtleties that you will not realize that could happen in a PMS. PMS have more concentrated portfolios. So in a bull market, they'll always do well. Make sure you know how this manager manages in a bear market. And then take a call of whether you do PMS or you do a focus fund in any mutual fund, which is a focus fund is fewer stocks, right? He's not allowed to put more than 25 stocks. Usually they're like 20 stock portfolios and 15 stock portfolios in some. So, and you get better, fees and you get better tax advantage. So you make that decision. But yes, PMS managers speak better than any fund manager. They articulate their principles and philosophy better than any fund manager. But then we need to be able to differentiate between marketing and reality.
Okay, I think, Aditi, I'm sure, your time is valuable. So, and anyways, this is a time-bound session. So we are just going to take one more question. The questions keep on pouring in. But this is a really, really contemporary question. I mean, if we find cryptocurrency confusing, then non-fungible tokens are even more bewildering. So Rashika Mudgil, our student, is asking, there's so much talk around NFTs. What are your thoughts on it? And if a beginner wants to learn more about non-fungible tokens, what should we do?
I mean, from the little bit I know about NFTs, there could be some value in the long run. I am not yet sure, but I see it in my eyes as little more valuable than maybe a Bitcoin. Do I know more details? Have I studied it more? I have not. Bitcoin and NFT, I haven't studied, and maybe I'm waiting for them to mature a little more before I do study. And if I have to lose some returns, so be it.
Great. I think the questions keep on pouring, but we have to draw the line somewhere. So Tushar, I think we are stopping here. Over to you.
Yeah, no, I think the session has been, before my closing remarks, I think there's a couple of questions that I do want, at least the women are asking questions now. I think there was one on, can you talk more about the 72 rule of investing? I think this is important.
Sure, this is very important.
Srushti has asked it. Go ahead.
Okay, so guys, it's just a thumb rule. You take the number 72. This is probably a mathematic formula to derive to this number, which I don't know. You take the 72, you divide it by the percentage that you expect in any fund. So if I'm expecting 10%, so 72 divided by 10 gives me 7.2. 7.2 is the number of years my money will take to double. If I put 1 lakh today and I'm making 10% return, I will double my money to 2 lakhs in 7.2 years. I still make 10% after that. my money, my 2 lakhs will become 4 lakhs in the next 7.2 years. 4 will become 8. 8 will become 16. That's already given me, see how many periods of 7 years that has given me. And that many years to, double, quadruple, make it 8 times, 16 times your money. So it's just back of the envelope calculation very quickly. And my point is, the earlier you start investing, the more periods you will have to be able to double your investment. Does that make sense?
Absolutely. So I think, given in the interest of time, I just wanted to thank Aditi for a glorious session. I thought, this is the start, guys. I think her message was very clear, and especially to all the women who are listening in, all our students who want to, save, start early and start now and start planning and start thinking about it now. This is not something that you need to postpone for 5 or 10 years later. You need to start now. And I think she's driven home the urgency. It's been really insightful going through all the asset classes, hearing her thoughts on, from Warren Buffett to, risk profiles and philosophies and processes to crypto, to gold. I hope that you guys have a flavor of what is required and what is necessary. We're really thankful for her to spare her valuable time in sharing it with students. And I think that, this has been, at least for me also, it's taken me back to the basics. So I hope you guys enjoyed it. I hope, and Aditi, thank you again for taking the time. It was really good. Thank you.
Most welcome. Thanks, everyone. And all the best in your investment journey. Start early. Thank you.
I think some students are asking if they have access to the PDF of your.
Well, I think if this is recorded, but we normally don't give the PDF out. Plus, it's the Winvest, it's the more women-focused one.
No, fair enough.
But they can just go to our YouTube channel. There's so many of these out there.
Yeah.
One thing, also, Tushar, if you can, if I can share some links with them, and I'll share them with you, and you can share them with the people who attended. So where they can get information. And if you give me their emails, when we do a lot of informative sessions.
Yeah.
And we can invite them to those.
Absolutely. Yeah. We can definitely send the links and details on the informative sessions. Thanks, everyone.
Someone is giving email IDs, so we can, if you can just give them all to me together, then I can put it in our system.
Yeah, we have it all.
Yes, students who want to connect with us, we will be reaching out to you very soon. You guys can show your interest for anything and everything that has been just spoken. So we'll reach out to you soon. Thank you so much. We can all start dropping off.